Today we're going to talk about Chapter 3, Cost Behavior. Now, there's a lot of learning objectives that we're going to go through. There's 7 on this page. I'm not going to read through them. Learning Objective 8, use variable costing to prepare contribution margin income statements for manufacturers, which is Appendix 3A. And Learning Objective 9, compare operating income approaches, variable versus absorption costing, again, Appendix 3A. We are going to cover those later on in the course as a separate, class. Learning Objective 10, use segment reporting to utilize the contribution margin income statement format in an organization with 2 or more divisions, which is Appendix 3B. In this course, we're not going to cover that. Let's start with Objective 1, describe key characteristics and graphs of various cost behaviors. In order to do that, we have to understand what cost behaviors are. So we know that to make good decisions, we have to know the past, but we also have to be able to make projections, good projections or predictions about the future. And in order to do that, we need to understand cost behavior, which is how costs change as volume changes. And when I say volume, I can also say level of activity. The volume doesn't have to be, a total number of units. It can be something else. Like the number of hours we run a machine is going to affect the cost of the utilities that we consume. So when I say volume, it doesn't mean just number of units. Volume can mean anything that we do, any activity that we do that changes the costs. And cost behaviors can be categorized into some very specific groupings. Let's start with variable costs. Total variable costs increase with volume, the level of activity. An example for a hotel would be the cost of the toiletries, the total cost of the toiletries, which are $3 per guest. Well, the total cost increases as the number of guests increase. And we can see that here. When we have 0 guests, the total toiletry cost at $3 per guest is 0. But when we increase it to 4 guests, the total toiletry costs are now $12. So that volume of guests is changing the total variable cost. Another example would be the cost of breakfast and snacks. So the cost of breakfast and snacks is $10 per guest. So for 0, of course, the cost is 0. If there's no guests, we're not going to pay anything for breakfast or refreshments. However, if we increase it to 3, we can see that the total cost is now $30. So total variable costs increase when the volume increases, and it decreases, by the way, when the volume decreases. So that's one cost behavior. Another common grouping is total fixed costs. And total fixed costs are constant, regardless of the change in volume or the level of activity within the relevant range, which we'll talk about in a second. But regardless of the changes in the level of activity, the cost is going to be constant. So an example for a hotel, the cost of leasing the hotel space, it's going to be the same no matter how many guests we have. So whether we have 0 guests, we still have to pay our lease costs. And if we have 500 guests, we still have to pay this $100,000 in lease costs. So total fixed costs are constant within the relevant range, which we're going to talk about right now. Relevant range is the range of activity within which the total fixed costs are constant and the per unit variable costs are constant. That may seem a bit confusing, but we're just going to expand on it for a second. For fixed costs, it's a capacity issue. To give an example of that, if the hotel has capacity, so number of rooms for only 500 guests, and then the demand for rooms is going to grow higher. So now we've got like 750 people who want to be there. We might decide to lease another hotel. So that first hotel, its $100,000 the whole time, up to 500 guests. Now, I want my capacity to increase, and I'm going to rent another hotel, and that other hotel is going to have like 350 rooms. Well, in that case, I'm going to go up, and now I'm not only paying that 100,000, I'm probably paying 150,000 or 170,000. So now this is the relevant range if I have above 501 guests. So the relevant range is between a level of activity of 0 and 500, and then above 501, it's going to go higher. So this is the relevant range if I keep below 500 guests. This is the relevant range if I have more than 501 guests. Now, what about variable costs? Let's assume that I buy a certain amount of toiletries and they're $3 per guest. But if I now have another location to buy toiletries for, I'm going to increase my order. And if I increase my order, I might get a volume discount. So then what's going to happen is my toiletry cost per guest is going to reduce to $2.75. That's going to change the slope of my line. But that only happens if I end up having more than 500 guests. If I have 501 guests and above, I get this volume discount. And so the slope of my total variable cost line is going to decrease because I'm paying less per guest. So this is the relevant range, the price per unit for variable costs if I have 500 or less guests. If I have 501 or more guests, my variable cost per unit is going to decline. So again, we got to look at the relevant range so that we choose the correct variable cost per unit. Remember, it's the slope that determines the variable cost per unit. Why is it so important to understand the relevant range? That's because we can only predict costs if we use cost information from the appropriate relevant range. If we use the relevant range of $2.75 per guest when we actually don't buy enough to get that volume discount, our predictions and our cost formula will result in totally incorrect answers. So knowing the cost information for the correct relevant range is really critical to making good predictions and making those predictions with the appropriate cost formula. Now that we understand relevant range, let's move back to cost behaviors. We got to look at mixed costs. Mixed costs actually have both a fixed component and a variable component. Well, let's look at this example. If a hotel were completely empty, the utilities would cost $2,000 per week. So we got a flat rate from the utilities company. These costs increase by $8 per guest. So as we accept guests into our hotel, we're going to have to pay $8 per guest for the utilities. So you can see this is a mixed cost. It has a fixed component, $2,000 per week, but it also has a variable component depending on the number of guests that we have. So a mixed cost, remember, it has a fixed component and a variable component. Let's do a quick check of our understanding. Which of the following costs is an example of a fixed cost? Salary of a plant manager, sales commissions, direct materials, delivery costs. And the answer is the salary of the plant manager. That's because sales commissions change if we sell more. Direct materials change if we produce more, and delivery costs change if we deliver more products to our customers. Which of the following is a characteristic of a variable cost? Variable costs per unit change with changes in volume. Variable costs are fixed in total. Variable costs fluctuate in total with production and sales. Variable costs do not change in total over any range. Variable costs fluctuate in total with production and sales. Now, why is A incorrect? variable costs per unit change with changes in volume, not within the relevant range. Sure, we'll have a change if we go outside the relevant range, but within the relevant range, the per unit variable costs stay constant. Variable costs in total will change with production. Renting a car and paying $35 per day plus 20 cents per kilometer driven is an example of what type of cost? Conversion cost, variable cost, fixed cost, mixed costs. Well, this is a mixed cost because it has a fixed portion, $35 per day, plus 20 cents per kilometer, which is the variable portion. For most businesses, annual straight-line depreciation expense on the company's building is what type of cost? Variable, fixed, mixed, or stepped. Straight-line depreciation is the same amount every single period, so this is a fixed cost. Let's move on to learning objective 2. Use cost equation to express and predict costs. Before we can talk about creating equations, we have to cover cost drivers. What is a cost driver? It's something that causes costs to change. That's why it's called a cost driver. It drives costs either up or down. An example, the number of kilometers driven determines the total gas bill. If you drive more kilometers, your gas bill will be higher. If you drive less kilometers, your gas bill will go down. The number of kilometers is driving the cost of total gas. So it's a cost driver. In management accounting, we need to analyze not just past costs, history, but also to predict what might happen in the future. Say if the kilometers driven increase by a lot, how much will we have to pay in gas bills in the future? To do that, we have to create a cost equation. Knowing the cost driver allows us to do that. And the cost driver we choose must have a strong relationship with the cost itself. So, for instance, the number of times you clean your car does not affect the total cost of gas. Not at all. The number of times you service your car, well, that will likely affect the total cost of gas because a better serviced car will probably use less gas. But it's not a strong relationship. So we can't use it to predict future gas costs. There's a weak relationship, but not a strong relationship. Another example would be the number of people you have in your vehicle. That will affect the gas consumption. But again, it's not a strong relationship, so it can't be used to predict gas costs in the future. The stronger the relationship between the cost driver and the cost, the better your cost equation will be at predicting future costs. So it's important to choose a cost driver that actually reflects the total cost you will incur. Now that you understand cost drivers, we can start working on creating an equation to calculate total cost. Let's use an example to do that. A company is manufacturing desks in a space that costs $10,000 per month to rent. The cost of the direct material is $30 per desk and $20 of direct labor per desk. So that's direct material, $30 per desk, direct labor, $20 per desk. What is the total cost if we produce 0 desks? What is the total cost if we produce 100 desks? And what's the total cost if we produce 1,000 desks? How do we determine total cost? And to do that, we need a cost equation. We know that total cost is equal to fixed cost plus the variable cost per unit, in this case per desk, times the number of units. So we can create a formula for that. And the formula would be y equals f plus Vx, where y is total cost, V is variable cost per unit, F is fixed cost, and X is the number of units. This is basically a mathematical equation for a straight line that can be used to predict total costs at different levels of activity, different volumes of desks. So now let's go back to the question. Remember, $10,000 per month is the fixed cost, and the variable costs are direct materials of $30 per desk and direct labor of $20 per desk. We know that F is $10,000. V is the direct materials and direct labor, so that's 30 plus 20, and X is the number of desks produced. So what is the total cost if we produce 0 desks? Well, we can plug it into the formula. 10,000 plus 30 plus 20, right, in brackets, multiplied by 0 desks, it's going to cost you only $10,000 because the variable costs in total are going to be 0 because we're producing 0 desks. And a variable cost only changes with the level of activity. What is the total cost if we produce 100 desks? Well, we can plug the 100 desks into the X from the formula. Now it's 10,000 plus, and the 30 plus 20 is 50, plus 50 times 100 desks. That's 10,000 plus $5,000. $15,000 is the total cost if we produce 100 desks. And if we produce 1,000, it's going to be 10,000 plus $50 multiplied by 1,000. That's 10,000 plus $50,000. That's going to cost us $60,000. So you can see that this cost formula is helping us to predict the total cost at different levels of activity, the volume of desks we produce. Now, if I summarize this information, you can see that total mixed costs, because this is mixed, this cost is mixed because it has a fixed portion and a variable portion. Total mixed costs increase as the volume level of activity increases. Because why? Because of the variable cost component, right? The 10,000 never changes. What's causing Y to change from the 10,000 to the 15 to the 60? It is just the variable costs that is causing the total costs to change. If we didn't change the volume, then the total cost would not change. So variable costs, total variable costs, cause the total mixed costs to change. That's important to understand. The mixed cost per unit decreases as the volume increases, and that's because of the fixed cost component. We can see that 10,000 divided by 0 desks, well, we can't determine that. Per unit costs, when we produce 100 desks, 15,000 divided by 100 desks is $150 per desk. But the variable cost per unit is still 50. So it's not the variable cost per unit that's causing this per unit, per desk cost to change. What's causing this to change is the $10,000 of fixed costs. So now if we produce 1,000 desks, 60,000 divided by 1,000 is equal to $60 per desk. Variable cost per unit is still $50. What's causing this to change is the fixed costs. So mixed cost per unit, right? $150 if we produce 100, $60 if we produce 1,000. It decreases because of the fixed cost component. Remember that total mixed cost, the graph, it slopes up, but it doesn't begin at 0. It begins at the fixed cost. So the intersection with the y-axis, which is total costs, is at the level of fixed costs. And it's that fixed cost that cause the mixed cost per unit to decline as we have higher levels of output or activity or volume. So we understand the cost formula. Now that we've got that, let's go back to cost behaviors and look at a few other cost behaviors. We can have step costs. So for instance, if we add more children to a daycare, we have to hire more childcare workers. Up to 8 kids, I only have 1 childcare worker. But if I do 16, between like 9 and 16, I have to hire another childcare worker. And then if I'm between 17 and 24, I'm hiring another one. So this is stepping up every time I move the relevant range. So step costs really are directly addressing relevant range. This range, 28,000, only is relevant up to 8 kids. From 9 to 16, 56,000 is relevant. So step costs step up. And keep in mind, it's really similar to when we increased the lease costs for our hotel by leasing a second hotel. Curvilinear costs aren't linear. They don't fit into some really easy straight line pattern. It's very difficult to have an equation for them. So we approximate curvilinear costs and we treat them as a mixed cost. And we create an equation that creates a straight line in order to use them in order to predict future costs. So we're going to do a problem in Excel. Fitness for Life fixed operating costs are $10,000 per month. Variable operating costs are $1 per member per month. The company's existing facilities serve up to 750 members per month. Required, calculate the following schedule for different levels of activity. We want the total variable cost per month, the total fixed cost per month, the total operating costs, variable cost per member, fixed cost per member, and the average cost per member. So let's start with the total variable costs. We know this is the variable cost per unit multiplied by the level of activity. So we know the variable cost per unit is 1. So I'm going to put the number of members here so I can use that. I'm going to actually put it all the way across. Oops. There. I'm going to use that in my calculation. So total variable cost is going to be the 100, and I'm going to multiply it by $1. So if it's 100 guests, it's going to be $100. If it's 500 guests, it's going to be $500. If it's 750 guests, it's going to be $750. And that's because the variable cost per member is $1. Total fixed cost is just the total fixed cost. So this is going to be $10,000. And because this is within the relevant range, it's going to be $10,000 for 500 guests, and it's going to be $10,000 for 750 guests. Total operating costs, of course, is going to be the variable cost plus the fixed costs. That's our formula, the equation we just worked on. I can pull it over. We're going to do the same thing. So you can see this is the 100 plus the 10,000. Variable cost per member, well, we're going to take the total variable cost and divide it by the number of members. And we're going to see the variable cost per member is going to be $1 all the way across. Because variable cost per unit, variable cost per whatever the volume is, doesn't change within the relevant range. But the fixed cost per member, that's going to change. As our membership increases, that fixed cost per member, it's going to decline. $100 if we have 100 members, $20 if we have 500 members, and $13.33 if we have 750 members. So what is the average cost per member? Well, if I add together the variable cost per member and the fixed cost per member, that's what's going to be the average cost per member. And we can see it's going down. Why is it going down? Not because of the variable cost per member. It's because the fixed cost per member is divided between more members. And so the average cost is going to be the mixed cost. The mixed cost per unit declines as the number of units goes up. All right. What about sustainability and cost behavior? Let's give an example to understand what this means. E-banking and e-billing reduces variable costs for both the bank and society. Why? Because we're reducing the demand for printed bills, and that's going to reduce the demand for paper, ink, shipping, disposal, because we have to throw these bills away. When we do something that reduces the variable cost, it actually increases our sustainability because we're not using as many resources as we did previously. We're reducing harvesting trees, we're reducing production of dyes, fuel to transport these letters, and then landfill space. Costs are reduced to both the businesses, and hopefully that'll trickle down to the actual customer. looking at cost behavior can help us plug in to sustainability practices in our business. All right, let's move on to learning objective 3. Use cost analysis and scatter plots to analyze cost behavior. So remember, we want to understand costs so that we can use our understanding to predict costs into the future. So there are 4 ways to analyze costs: account analysis, scatter plots, high-low method, and regression analysis. So account analysis, this is where we go into the accounts in our accounting system and we basically judge them. We classify each of the general ledger accounts into variable, fixed, or mixed. And really, we need to have a lot of knowledge of the business and the operations of the business in order to do that. And the fact is, not everybody is going to categorize them in the same way. And so it's really subjective. Account analysis is probably not the best way to create a cost function that we can use to predict future costs. So what's a better way? We can look at scatter plots. So we're going to use the historical data to determine the cost behavior. We're going to plot them on a graph with a y-axis of total historical cost and then an x-axis of the volume, right? Whatever that level of activity happens to be. And it really helps managers to visually see how strong the relationship is between the cost and the cost driver, the level of activity. Remember I said we need a strong relationship, because if we don't have a strong relationship, then it's not going to be very good. That equation we produce is not going to be very good for predicting future costs. So this is a scatter plot. We've taken the historical data and we've just plotted it on a graph. And we can see there's a strong relationship between total utility costs. So total utility costs over here, there's a strong relationship between the total utility cost and the number of guests. And how do we know that? Because we can see that all these dots are grouped very close together and they all seem to be moving in the same direction. So we can see that as the number of guests increase, going up here, we can see that the total cost increases and there's a strong relationship. Here we can see that there's no relationship between the level of activity and the total costs. The data points are almost random. What does that mean? It means that any cost formula we create will do a very poor job at predicting costs at different levels of activity. That's because there's no real relationship between the cost and the cost driver, the level of activity. Going back to the scatter graph for the hotel, it's clear that there's a relationship between the number of guests and the utilities costs. But we can also visually see an outlier. Right here, this is the outlier. That's a point that doesn't follow the general pattern. Using scatter graphs, we can quickly identify this outlier and we can ignore it since it's abnormal. If we include outliers when we create a cost formula, the formula won't do a very good job of predicting costs at different levels of activities because we've used an outlier. So what's the problem with using scatter graphs? Once we eliminate the outliers, we would have to estimate the cost behavior line to create a formula. Here's my cost behavior line. The problem is that if you had this scatter graph and you drew your cost behavior line, it would be different. And then we have to use the slope of this line to determine variable cost per unit. But if everyone's line is different, then everyone's variable cost per unit would be different. Everyone's intersect for the fixed cost would be different. And so everyone's formula would be different. Scatter plots may be great at identifying outliers, and they're awesome to determine if the cost driver has a strong relationship with the costs. But they're too subjective to be good at creating cost formulas because it's so subjective that every cost formula would be different for every person, and that means it would be a poor predictor of costs in the future at different levels of activity. So what's another method? we can use the high-low method to analyze cost behavior. So let's look at the high-low method. How does it work? It fits a mixed cost line. We can see it's mixed because, of course, this is not at zero, right? So it fits a mixed cost line through the highest and the lowest point in the data. We then use this to develop a cost formula which will help managers predict costs at different levels of activity. How do we do that? Step one is we need to find the variable cost per unit, which is the slope of the mixed cost line. Step two is to find the fixed costs. That's where it intercepts the y-axis. And then we create the equation. What's the advantage? It's really easy to use and it's easy for managers to understand. What's the disadvantage? Well, we're only using 2 points and we are ignoring all the other points on the line. And because we're ignoring all the other points on the line, our cost formula, it's definitely not perfect. No cost formula is ever going to be perfect, but it's probably going to be a little less, effective for predicting costs at every level of activity, because we could end up with costs up here or costs down here. So depending on how big these costs are, we may end up with a good cost formula, but not a perfect cost formula. So now let's do an example in Excel. In this question, we have all the months of the year and we have historical data, the total guess for all those months and the total utility costs for all of those months. Required, calculate the variable cost per unit and the fixed costs using the high-low method. So step one is to find the variable cost per unit, the slope of the cost line. So how do we do that? To start that, we actually have to find the high-low points. So really, to do step one, we have to find the high-low points. What do? Do we use the utility costs or the guess volume? Always use the level of activity. To find the high-low. So we're going to look here. We want to find the highest number. We're just going to visually look to see what the highest number is. And it looks to me like it is right here, $24,900. If I look, nope. I thought it was August, but I'm wrong. It's July, $25,200. So I'm just going to visually check. Yes, this is definitely the high level. Once we find the high level, we always take the related total cost. So I want to be clear about that. If we find the high level, we're not just taking the activity. No, we don't find the high level of the volume and then the high level of the cost. No, we find the high level of the volume and we automatically take this cost. Even if there's a cost that's higher, we don't care. We take the related. So we know that this is the high. Now we have to find the low. So the low looks to be, I got 13,250 in January. Is there anything lower? There is nothing lower. So now we know that this is the low. This is the low. Remember, once we have the low activity, we automatically take the total costs that relate to that low activity. We don't look for a lower cost in here. No, we simply take this point and this point. So now, how do we calculate it? We are going to take the high dollars and subtract the low dollars. We're going to divide that by the high activity, subtracting the low activity. That's the formula. Let's just put it in a little bit better. There we go. Here we are. That's the formula to find the variable cost per unit. I'm going to move this down so that it doesn't interrupt us. There we go. Okay, so we've got the high dollars, $209,600. We're going to subtract the low dollars, $114,000. We're going to take the high activity, $25,200, and we're going to subtract the low activity, 13,250. And we're going to divide them. So let's do the calculation first. 95,600. Now I'm going to do the same calculation here for the activity, 11,950. So I'm going to divide these two, and it's going to tell me the variable cost per guest. $8 per guest. That is the variable cost per unit, the slope of the line, if we created a graph of this. So $8 per unit is the variable cost. Now I'm going to use that information to calculate the fixed cost. So let's move this down. So how do we calculate the fixed cost? We take our formula. Remember that formula? Y equals F plus Vx. So we're going to plug that formula. We know that Y equals total cost. So in that case, I can either take the high or the low. Doesn't make any difference which I use, so I'm going to use the high. There we go. We know that F is equal to some unknown number. We know that V is equal to, well, we just calculated it, it's equal to $8 per guest. And we know that X is equal to the number of guests. The number of guests. If I use high here, I have to use the high here. So the number of guests I'm going to use is the high. I can now just plug them into this formula. So I know Y is equal to fixed costs, which is a question mark, plus $8 per guest multiplied by 25,200 guests. So if I look at this formula, I can now make a calculation. 209,600 is equal to the fixed cost, which we don't know, plus the variable cost, which we can calculate, 8 multiplied by 25,200, that equals $201,600. Well, I can now solve for F, of course. 209,600 subtract the $201,600, that's going to be equal to my fixed cost. Guess what? Fixed cost is equal to 8,000. Now, can I use the low point to calculate the fixed costs? So let's look at it. So I'm going to just change this to low. And I've got to change this to the low also. 8,000 total fixed costs. Now, if we had to round the variable cost per level of activity, then the high and the low might be slightly different. But otherwise, it's going to end up being exactly the same. So now we can create our cost function. We now know that total cost is equal to fixed cost of $8,000 plus the variable cost, which is $8 per guest, multiplied by whatever X happens to be. So we can see that we could now use this to calculate the total cost at any level of activity. So we could calculate the total cost at a different level of activity. So we're going to look at the 8,000. We got the 8,000. And we're going to add in, I'm going to take it from over here. We're going to add in the $8 per guest. There we go, $8 per guest. And we're going to multiply it by some different level of activity. It has to be within the relevant range. The relevant range is between this high and low. We cannot go outside of that high and low. So let's assume I want to know for 23,580 guests. I can easily calculate that. Take the 8, multiply it by the 23,580 guests. Add these two together. Fixed cost of 8,000, 188,640. Let's just widen that. There we go. Total cost at 23,580 guests will be 196,640 approximately. So we can use this formula to predict different levels of activity as long as they are within the relevant range. Awesome. That's the high-low method. What is the mistake students make all the time? 1, they will pick the low activity and then they'll go through the costs and pick the low cost. Now in here, I don't have an example of that, but let's assume that this was 110,000. I've had students pick 13,250 and then 110,000 because they look for the low in the volume and then they look for the low in the total cost. No, we don't do that. We picked the low volume and take the related cost. We pick the high volume, take the related cost. So that's one error I see. The next error is that they flip these. They don't take the dollars and divide it by the activity. They take the activity and divide it by the dollars. And we just can't do that, right? That's because the activity is driving the costs. So we're always going to use the activity as the denominator. The numerator has to be the dollars. So those are the 2 errors I see all the time. Don't make those errors. Let's move on to learning objective 5. Use regression analysis to analyze cost behavior. So now we're going to do something very different and we're going to use Excel. So in order to do regression analysis, we first have to add the data analytics tool into Excel. So what we want to do is we want to go up to File. And then we want to go down here to Options. So the lower left-hand side, you want to look at Options. Sometimes what you'll see here is you'll see up here a word More. You can click on More. So down here, I'm clicking on Options. Up here, other people are clicking on More. So I'm going to click on Options. Now, we're going to go down here and we're going to click on Add-ins. So click on Add-ins. Now, we want to click on Analysis Tool Pack. So where is the Analysis Tool Pack? See here, Inactive Application Add-ins, Analysis Tool Pack. So I'm going to click on the Analysis Tool Pack and I'm going to say Go. I didn't say okay, I said Go. So now you see this little listing. I'm going to click on Analysis Tool Pack and I'm going to click on OK. So now go to your Data tab. Right at the top, you're going to see Data. Click on Data. And then I'm going to go here and click on Data Analysis. Now some of you will not see this. Instead, you're going to see a little icon that looks like that. So I've got Data Analysis over here. Some of you are going to see this icon. If you see this icon, click on this icon. I'm going to get rid of it. So I go over to Data Analysis over here. I'm going to click on it. So now I need to look through these. I want regression. So I can see regression right here. So click on regression and then say OK. So we want to input the Y range. So the Y range is the cost, right? So I'm going to click on the cost. I'm going to include the heading. There's the Y range. Okay, it includes the label. I'm now going to do the X range. The X range is the level of activity, and I'm including the heading. And I'm going to click OK. And in a new sheet, it's going to produce my output. This is called summary output. So I'm going to make it larger. Wait 1 second so that we can see all the words. There we go. Now I'm actually going to go like this. There we go. So what does this all mean? There's some things you have to pay attention to and some things you can just totally ignore. The intercept right here. I'm going to highlight this. The intercept is the fixed costs. So let's just highlight that. Intercept equals total fixed costs. The guessed volume over here, and this is usually called X variable 1. Just so you know, if you're doing it, it's called X variable 1 usually. This is equal to the variable cost per unit. So now we can create our formula, right? Y equals the fixed costs plus the variable cost per guest multiplied by any level of activity, which is X. So here's our formula. Total cost is equal to fixed costs of $14,538 plus $7.84 multiplied by the number of guests. I can now use this to predict costs at different levels of activity. Regression analysis provides the best predictor of total cost. Why? Because it creates a line that is the best fitting line given all the data points. Now, how do we know whether this will produce a really good equation? We look at the R squared value. So here's the R squared value right here. Super critical. This tells you the goodness of fit. It tells you how well does the line fit all of the data points. The higher this number is, the better the fit. If it was 1, then all the data points would be on the line. So that's a perfect fit. That equation is going to be awesome. This equation is really good. The R squared is just slightly below 1. So this is a really good fit. How do we know when it's a good fit? Like, what number should we see? We know this is a good fit because it's just slightly below 1, and 1 is a perfect fit. So what do we need to see? We want that R squared number to be greater than or equal to 0.80. Anything above 0.8 is going to be a good fitting line, which will produce an equation that will do a very good job of predicting costs in the future. So this is the best method to use. And again, I want to highlight the importance of the R squared value. If the R squared value is 0 or, low, what it's indicating is that the cost driver is not driving the costs. It's just a random scattering, and no line is going to be able to produce an equation that will do a good job of predicting costs. If we have an R squared value of 1, then it's a perfect fit. And we want the R squared value to be equal to or above 0.8 in order to produce a cost function that's going to be able to do a good prediction of future costs. Keep in mind, if you end up with a scatter plot that's random like this, you probably have the wrong cost driver, and you just need to find a better cost driver. And you might move from having this random listing to having, well, not this, but at least having something above 80 for the R squared. It doesn't mean we can't predict costs. It just means you chose a really bad cost driver. All right, that's regression analysis. So let's move on to learning objective 6, analyze cost behavior and make predictions using data analytical tools. We can use data analytics as a predictive tool. It makes predictions by really identifying patterns in really large sets of data. So we could take 10 years of costs and we could produce a really good cost line using those 10 years. The larger the data set, the more information we have to work with. Regression analysis is one of those tools. We're building a cost function that will help us predict costs in the future at different levels of activities. By the way, we could use this tool to use more than one X variable to predict Y. So it won't just be the number of guests. It might be the number of guests and the length of their stay. So now we have multiple regression analysis, and it provides a better tool, the cost function, to help us predict future costs. So data analytics helps us create better cost functions to do a better job of predicting what will happen if things change. So keep that in mind. Data analytical tools, very important in accounting. Learning Objective 7, prepare contribution margin income statements for service firms and merchandising firms. We have the traditional income statement, which is a course from your introductory financial accounting course. It's organized by function. So what does that mean? Well, we look at product costs and then we look at operating costs. Product costs are the costs that go into the product. So that's by function. The function of that cost is it's going into a product. But then we do period costs, and that's the function. That's the organization, the administration, all the rest of it. So we divide the traditional income statement by function. So product costs are direct materials, direct labor, and manufacturing overhead. Period costs are selling, general, and administrative expenses. And we end up with a very standard income statement, which starts off sales revenue, less cost of goods sold, create gross profit, less operating expenses, and then we have operating income. This is what's required under IFRS. But we know now, because of cost behavior, that cost of goods sold with the direct materials, direct labor, and manufacturing overhead, some of these costs are variable, like direct materials and direct labor, and some of them are fixed, like the depreciation, straight line depreciation on the plant equipment. So it includes both variable and fixed costs. Operating expenses are the same. They include variable costs such as sales commission, increasing with the number of sales, and fixed costs like the rent payments on the corporate offices. So in management accounting, we want a better understanding of cost behavior, so we want to look at our income statement taking cost behavior into account. So we use a contribution margin income statement. It's organized by behavior. We split the costs into variable costs and fixed costs. Then we calculate the contribution margin, which is sales minus variable costs. And what is the contribution margin? It's the amount of profit that is contributing to the coverage of the fixed costs plus profit. So our contribution margin income statement starts with sales revenue, same as it did before, but we deduct the variable expenses. And that means the variable expenses that are both product expenses and period expenses. Everything that is variable gets dumped into this one category. And then we have the contribution margin, which tells us how much profit, $21,600, will contribute to the coverage of the fixed costs, which are $11,000, and contribute to our profit. So contribution margin is a really important concept, because if our contribution margin is too low, we will never be able to cover the fixed expenses and we will never be able to produce a profit. The structure of the contribution margin income statement, sales revenue minus variable costs is equal to contribution margin. Contribution margin less fixed costs is equal to operating income. By the way, the operating income between a contribution margin income statement and a traditional income statement are the same. You can see our operating income here, $10,600. Our operating income here, $10,600. Here, all the variable expenses, both product and period costs, are grouped together. And then all the fixed expenses, both product and period, are grouped together. By separating variable and fixed costs, it shows how much revenue contributes to covering fixed expenses and generating profit. It's a really powerful tool for decision making. We know that learning objective 8 and 9 we're covering in a future class all by itself, because it's a pretty big concept, so I want to be able to cover it in detail. Learning objective 10 we are not covering in this course. All right, let's do a quick check of everything we've learned. 1. If a per unit cost remains constant over a wide range of volume, the cost is most likely a variable cost, a fixed cost, a mixed cost, or a step cost. So per unit cost constant. We know that the answer is variable cost because per unit variable cost stays constant. Per unit fixed cost decreases as the volume increases. And mixed costs per unit decrease as the volume increases. And step costs, they increase as the volume increases. So only variable costs stay constant per unit within the relevant range. 2. The cost per unit decreases as volume increases for which of the following cost behaviors? So cost per unit decreases as the volume level of activity increases. A, variable cost and fixed cost. B, variable cost and mixed cost. C, fixed cost and mixed cost. D, only fixed costs. We know, because I just answered this question, fixed costs and mixed costs. Per unit fixed costs decrease as the activity increases, and mixed costs decrease because of their fixed cost component as the activity increases. 3. In the mixed cost equation, y equals f plus vx, which amount represents the total variable cost component? A, y, B, v, C, f, D, vx. And the answer is vx, because that's the total variable cost. 4. Which of the following would generally be considered a committed fixed cost for a retailing firm? A, cost of a trip to Cancun given to the employee who is Employee of the Year. B, lease payments made on a store building. C, cost of sponsoring the local golf tournament for charity. D, cost of the annual sales meeting for all employees. A committed fixed cost for a retailing firm. Committed meaning we cannot change this. It's not discretionary. It's going to happen all the time. And the answer would be the lease payments made on the store building. All the other ones are discretionary costs, not committed costs. Which method is used to see if a relationship between a cost driver and total cost exists? So we want to see, is there a relationship? Is there a strong relationship between the cost driver and the total costs? A, scatter plot. B, variable analysis. C, outlier. D, account analysis. And we know immediately to visually see whether there is a relationship, we use scatter plot. 6. How is the high point selected for the high-low method? A, the point with the highest total cost is chosen. B, the point with the highest volume of activity is chosen. C, the point that has the highest cost and the highest volume of activity is always chosen. And D, both the high point and the low point are selected at random. And we know the answer is B, the point with the highest volume of activity is chosen. Remember, the activity, the cost driver, is what drives the costs. So we always use the activity to choose the high point. 7. What is the advantage of using regression analysis to determine the cost equation? A, the method is objective. B, all data points are used to calculate the cost equation. C, it is generally more accurate than the high-low method. D, all of the above statements are true about regression analysis. And the answer is D. All of the statements are true. It's objective because everybody will get the same answer. All the data points are used to calculate the equation, and it is more accurate. It's better at predicting future costs and creating a cost function than the high-low method, which only uses 2 data points. 8. The contribution margin income statement, A, provides owners with cash flow information. B, is required for external reporting. C, is useful to managers in decision-making and planning. And D, arrives at operating income by subtracting operating expenses from gross profit. And the answer is C, is useful to managers in decision-making and planning. It's not required for external reporting. In fact, it's barred we have to use the traditional for external reporting. It has no cash flow information, only the cash flow statement does. And operating income is not calculated by subtracting operating expenses from gross profit. That's the traditional income statement. That's it for Chapter 3, Cost Behavior. Remember that in class, we're going to do a lot more examples.